Chipotle just reported Q2 2026, and they actually beat Wall Street consensus. EPS came in at 33 cents, which is a 1-cent beat, and revenue hit $3.35 billion.
Right.
That's a $17.2 million beat, up 9.3% year over year.
Yeah, and management immediately raised their full-year comparable restaurant sales guidance to the low single-digit range.
Wow.
And, I mean, the market loved it. The stock popped nearly 6% in after-hours trading, so it settled right around $36.25.
So headline numbers are out of the way. Today, we are taking a deep dive into the earnings materials and notes to answer one really crucial question for you. Is Chipotle's obsession with speed actually masking some, pretty serious cracks in their financial foundation?
Right. Well, to figure that out, we have to look at how exactly they got that revenue beat, because it wasn't just them jacking up the price of guacamole again.
Which they love to do.
Right, exactly. But comparable restaurant sales grew 2.2%, and actual foot traffic, meaning total transactions, that increased by a full percent.
Wow, that's pretty rare right now. A lot of chains are showing revenue growth purely through inflation pricing, not actual customer volume.
Yeah, definitely.
And digging into the notes we're looking at, a huge chunk of this is digital. Over 38% of total food and beverage revenue is just digital now.
It's massive. CEO Scott Boatwright calls this their recipe for growth.
Okay.
And, part of that recipe is the menu itself. So they're rolling out things like the Chipotle honey chicken and that cilantro lime sauce to get people in the door.
Right.
But the real engine here is footprint expansion. They opened 100 new company-owned restaurants this quarter, and 80 of them have Chipotlanes.
Okay, let's talk about those Chipotlanes for a second.
Yeah.
Because looking at the layout in the notes, they aren't traditional drive-thrus with a squawk box.
No, not at all.
You order ahead on your phone and you just roll through to grab the bag. It turns a premium restaurant into essentially a high-speed toll booth for burritos.
Yeah.
Like, it's designed purely for volume.
It really is, yeah. It drastically reduces friction. A digital order pushed through a Chipotlane process is significantly faster than, walking a customer through the traditional make line.
Where they just point at the rice and beans they want.
Exactly.
But wait, if they're acting like a high-speed toll booth pushing record volume, why are the margins bleeding?
Because I'm looking at the restaurant level operating margins, and they dropped 220 basis points year over year.
Yeah, falling from 27.4% down to 25.2%.
Right. So if throughput is at all-time highs, shouldn't profitability be expanding?
You would think so, yeah. But the cost of operating that toll booth is it's surging right now.
Okay, how so?
Well, first you have commodity and supply chain inflation. So specifically, beef and freight costs are taking a larger bite out of every single transaction.
Oh, right.
And then add in labor. Wage inflation is really sticky. Plus, they're paying out more in performance bonuses to the staff who are actually running those high-speed lanes.
Okay, that makes sense. The volume is up, but the cost to serve that volume is rising even faster.
But there's another headwind in the sources, right? The Cyclospora and Salmonella headline scare. Obviously, nobody wants to hear that when they're ordering lunch.
Definitely not.
But how exactly did that hit the financials? Because it didn't impact this Q2 print, right?
No, Q2 was clean, but late July took a massive hit.
Oh, wow.
Yeah, when those headlines break, two things happen instantly. Foot traffic plummets overnight because of consumer fear, obviously.
Right.
And restaurants often have to purge inventory to ensure safety protocols. So that sudden shock created a 200 basis point drag on margins just in late July.
Wait, really? Just in July?
Yeah, which forced management to issue a very cautious 1% comp growth estimate for Q3.
Hold on. I'm trying to square this circle here. They took a 220 basis point margin squeeze overall, and they just had a brutal July health scare that wrecked Q3 estimates.
Yeah.
So how is management justifying raising the full year guidance? It feels, overly optimistic, almost like they're whistling past the graveyard.
Well, it's a calculated brute force bet. They are betting that their back half menu innovations, combined with the sheer processing power of those 80 new Chipotlanes, can just outrun the sticky inflation and the health scare drag.
I see.
They need massive transaction growth to offset the higher costs of beef, freight, and wages.
Outrunning your own operating costs. It brings me right back to the toll booth analogy.
Yeah, it really does.
Which, if you're a shareholder or just someone watching the market, it leaves you with something to really mull over. With margins shrinking while drive-thrus and sheer transaction volume become the primary focus, is Chipotle quietly abandoning its premium fast casual roots to become just another volume-dependent fast food chain?
It's a great question. If you step back and look at the underlying mechanics, it definitely points to a shift from premium margins to mass market scale.
Make sure you follow the show for your daily earnings coverage.